Thank you, sir.
Mr. Diaz, happy afternoon. I hope you're doing well. Tuesday afternoon. It's been a while since
Happy
we did one
Tuesday.
of these. How are you doing?
Yeah, I'm doing good, man. And Tuesdays are supposedly the most productive day of the week, so I feel it. I feel
Oh yeah?
productive today. I know you've been. We talked earlier. You've been juggling a lot of stuff, which is good, right? Keeps us out of trouble.
Yep.
Yes, sir.
Staying busy. His pops always told me, I know, Dad, when are you going to retire? And he says that it keeps him young. Working keeps him young. And if he didn't work, he didn't know what to do. I'm like, man, that's really interesting because I could have thought about a list of things that I would do with my hobbies if I was retired.
I don't even know how to spell that word, to be honest with you, but
Yeah.
hey, good for those people who have deployed their retirement, because that's definitely, I'm one of those people that I'm just built to work till I die, man.
Yeah.
I'll sleep when I die, as I say. There'll be plenty
Man.
of time.
That's a hustler, man. So yeah, I think this would be the first one in 2023 we did. We did a decent amount of them in 2022. And I'm really glad that we're picking this up because ever since our last video podcast, I mean, man, so many things in the real estate market has changed, right? From rates to buyer interest, sellers interest, to market.
So true.
I mean, the regional bank situation. I mean, where do we start?
Well, let's do high level, man. I mean, let's talk about, the big elephant in the room. We all know, right, that the Fed increased rates by 1/4%. Now, what are we talking about when we're talking about the Fed increasing rates? That is not about mortgage rates. Does it affect it? Of course, because look, the economy works in a microcosm. Everything affects everything, right? But when we're talking about the Fed specifically and their actions, they're talking about the short-term interest rate, specifically what's called the federal funds rate. What is the federal funds rate? It's the short-term rate that banks use to lend each other money overnight. What does it affect for us as consumers? Well, it affects essentially two things. One, credit cards. So your credit cards went up by 1/4% instantly. And then secondly, your home equity lines of credit, or HELOCs as we like to call them, those went up as well. Now, a little factoid about credit cards. Credit card debt in the United States at this point, which today is the 16th of May of 2023, Tuesday, we are this close to being at $1 trillion in credit card debt. That is extremely scary. If you're watching this and you are one of those folks that have increased your credit card debt substantially, and you own a home, there's no reason to keep your credit card debt in existence. You need to call myself or your trusted lender if you already have one. Let's do a free consultation. Let's put a strategy together to get rid of that, because here's the truth. Those kind of rates, the average rate right now on a credit card is 21%. If that's
Yeah.
you, that's a drain on your finances and your income. You're essentially working part-time for these credit card companies, if you think about it in real terms, right? So don't do that. Let's talk it out. Let's repurpose. One of the beauties of homeownership is that it creates this little thing, which I call basically passive income and passive assets, which is called equity, that you can repurpose to either pay off debt, start a business, right? Take a vacation, all the above. But equity is no good unless you deploy it. Of course, it feels good to accumulate it. But if you're accumulating equity at let's just call it 7%, but your credit cards are at 21, we have what's called a disjointed financial situation. Let's not do that. Let's level it out so that you don't put your money in jeopardy. I've always said this, your money needs to be working harder than you. So the question is it? If it's not, let's talk, right? So that's one piece. The other piece, boy, these banks, right? What's been going on? We've seen these banks going out of business. Why are they going out of business? Let's decipher this for a second.
So we're talking Signature Bank, we're talking Silicon Valley Bank, right? We're talking Credit Suisse, we're
First
talking
Republic Bank.
First Republic. I hear some rumblings down south with PacWest.
Yeah, PacWest seems to be the next one in line. And so let's unpack this for a second. Why is this happening? Well, if you peel the onion, you look behind the curtains on these banks. What do they do in reality? Well, most of these banks cater to a specific sliver of the population. Let's take First Republic Bank, for example. Great bank, by the way. founded here in San Francisco, family owned. They decided that they wanted to pursue the high net worth person that would bring large deposits to the bank, and in exchange for that, that they would give them the ranch. That group fits in a box about this size, everyone, right? They are perfect. They have super high credit scores, high net worth. They're bringing a lot of money to the bank, right? They're buying McMansions. They're this segment of the population. So they bring over their monies, and First Republic in exchange decides, you know what? We're going to give you a super low interest rate jumbo in exchange for your deposits. I know a person, for example, that had a 1.25% loan, interest only.
Wow.
And that loan was big. I know that loan was big.
Was that your guy in Marin County?
Yes,
Wow.
exactly.
Ooh.
So he gets, think about it. So you are now First Republic Bank collecting how much? 1.25% in income, let's call it, right? You
Mhm.
take that income and you invest it as well, right? As well as deposits. Because for those of you who don't know, the Federal Reserve requires 10% reserve requirements. That's it. So 90% of your money right now is being reinvested and lent out. Okay. But now the market switch, because everything in life goes in cycles, right? What goes up comes down, and what comes down goes back up, right? That sort of thing. But here we are in an interest rate environment that is being ratcheted up by the Fed. So think about this. You are making 1.25%, and maybe in your investments, now that you bought bonds, let's just say, as an investment at 3%, now the market shifts and now you're at 6.5%, but you're also at short term at 4.5, 5. Now, guess what? Your savings accounts and your CDs are requiring you give them that kind of yield, that you give them 5% on their money.
Mhm.
But you're losing money on your investments and your income's very low. You can't pay out that kind of money on deposits anymore. So what do? You have one or two options. Either go asking for money, right, to Wall Street or whoever, or investors. But the problem is that if you have those kind of problems, most likely people don't want to give you more money because they don't want to put a band-aid on a gaping wound, right? So guess what happens? You have a run of the bank. A lot of these depositors start to bail on you
Mm.
because they go to Bank of America, they go to Chase, they go to Wells Fargo, who's offering them the 5% on the money market because they're huge. But you're not big enough and you're losing money and you're losing depositors. Now you are basically insolvent. So in the case of First Republic, last I checked, about 68% of their deposits were not even insured because why? They cater to the high net worth person who deposits more than 250,000, which is the FDIC
I see.
insurance level. And so now you have insolvency and you have these banks crumbling. And that's what we're seeing. Silicon Valley Bank happened to cater to the techies, right?
Mhm.
But again, they didn't invest well and they were giving them the house. Look, at the end of the day, folks, let me say something because this comes up often. There is no free lunch. It's got to come from somewhere. Unless the organization that is giving you the loan is a 501c3, which is a nonprofit, they have to make money just like you do. What happens if somebody else came and asked you for a bunch of money and tells you that I'm not going to pay you for 2 years and I'm not paying you interest? Would you laugh at them or not? So
Good
stop
analogy.
trying to get free lunch from these organizations. Stop trying to pinch the system because you might be the problem of why these companies go out of business. Because what's important is, I love the old saying is that rising tides lift all boats. That's what needs to happen. Please put into context that when you're negotiating with someone and you're trying to get free stuff, it's costing the organization and therefore others dearly. You could be the next reason why that organization goes out of business because maybe you're not the only person doing that. So we have to also give grace to get grace, is what I'm saying here. Please realize that everyone needs to make money, including you. When was the last time you donated 2 weeks of pay to your organization? Never, I
Right.
believe is the answer. So I say all this because, it happens all the time. Well, can you give me a free credit report? Well, it's got to come from somewhere. Can you give me a free appraisal? Can you give me free, 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 free? If you're making pretty good money, I would say, you know, keep those kind of asks to a minimum or non-existent.
Yeah, I mean,
Look
especially
at the bigger
let's just
picture.
say if you're working, right, you're a software engineer and your boss says, "Hey, listen, like you've been doing great, but we would really appreciate it, for the sake of the company and to show you're a team player that if you would work the next 2 weeks and just not really take a salary, but we just want to make sure that we can cut some costs here and there, and we want to make sure that we still get all the perks of having you and your coding and this and that, but just not pay you for the 2 weeks." I mean, nobody would want to hear something like that. They could
Nobody
care
would want to
less.
hear that. And so when they come to you
Yeah.
and I, asking us for free credit report and all these things, look, it's not that we don't want to. We also have to be in business. Guess what? We also have families. We are humans just like you. And just like we don't come to your place to ask you to work for free for us, a little bit of that mutual respect and reciprocity is greatly appreciated. So, not to go off on that tangent, the next thing that we want to talk about is, retail sales came in. Well, they came in half of what the market expected at 0.4, but
Mhm.
they still came up a little bit. Those are April numbers. Rents came in 4.3% higher. So if you're renting, notice there's no bubble there. It's not like rental prices are coming down. It still makes sense to buy a home if you can. Now, granted, is home ownership for everyone? No, nothing, by the way, is for everyone. There are
Right.
no absolutes, not everyone and not no one, right? But by and large, home ownership is still alive. By the way, this too shall pass. And trust me when Uncle Ed says that those of you who think that you're a great market timers and you're just waiting for rates to come down, so is everybody else. There's millions of you that are out there waiting. So guess what's going to happen when rates do come down to the fives? Everybody's jumping in, and we're going to go back to the cycle where you get outbid because there's 15 to 18 offers on that one property, right? And they're offering 100, 200,000, whatever, over asking. And now there's no seller who's going to give you credits for closing costs. They're not going to lower the price. And now you are forced to continue being a renter because you thought you could time it. Look, even us seasoned assassins who've been doing this for a long time are not even that accurate at being able to time. I'm pretty good, but I'm not infallible and I'm not 100%. So think about it. You're going to compete with somebody like me? Probably not.
Yeah.
Probably not, because this is all I do, just like I wouldn't compete in whatever area of expertise you are, right? So on that note, give me that one example that you mentioned to me of a property recently, your dad's property, man, that he had listed.
Oh,
Tell
yeah.
us that story of, look, here it comes, everyone.
Right, absolutely. So this is an interesting trend that I've noticed for the past few listings that we've had. We had one off of Homestead, which is down the street from Kaiser Santa Clara. I would say think between Kaiser Santa Clara and Scott Boulevard on Homestead. It was a property on Lansford. Now we listed that one 200 grand above the comparable, the closest comparable, and the reason for that is because that seller had worked with an out of town discount broker, and the tenants were making it very challenging to show the property as well. So you had an out-of-town agent who had no idea about the local market, and you also had tenants that were making it challenging for folks to come by and take a look at it. So that property ended up sitting on the market for a few months. They sold it around 1.32 million. Now we come along about a month or two later and put our subject property on the market 200 grand more, around 155, I think it was. And we ended up getting 8 offers on this property. It sold for 1.68, which comes out to around $360,000 higher than the comparable that sold just 2 months prior to that. And by the way, that comparable that the discount broker sold had a lot size 2,000 square feet higher than ours. It's a planned community. So this one had a much bigger lot in this planned community than ours. So it just shows that who you work with really does matter. I mean, and I can go on this type of data for days, and I do this at our listing appointments. I can sit down, I'm like, okay, interesting. Let's break this down, because numbers don't lie, right? We go off of the data. Now, a second property, we had a tri-level single family home on the corner of Lawrence Expressway and El Camino. This property was built in 2009-ish. The bedrooms were on the second and third stories. That one sold for $140,000 above asking price just a few weeks back. Now, that brings me to the property that you had just asked about. This was in an area of Santa Clara that had a really good elementary school, Sutter Elementary. Most of these websites like greatschools.org has it listed as a 9 out of 10 elementary school. And we put this home on the market at 1.65 mil. I would think that the home hasn't been upgraded since like 92, 93. Think about that, like those black colored toilets, like for example, the what's it called, the counters with the tile counters that have a lot of the grout in the middle, but food gets stuck in and stuff like that. That's old, really old school. So we ended up getting offer deadline today, and that property sold well above 200 grand above asking price. So I'm sharing this information to not necessarily be like, this is what we do, this is how much we sell homes. No. When you do your due diligence and you're a strong agent in the market, and you market the home, you do a good job for your clients, you see how much these homes are going for. Previously, if you would have asked me around Q3, even Q4, we would have gotten offers. Let's just say it was on the market for 10 days. If it was multiple offer situation, it'd be 2 or 3. Now I'm seeing around 10 on average for the homes that we're writing offers on. There was a property in the Cambrian area of San Jose, which is on the border of San Jose and Los Gatos. And that home, it was a fixer-upper that most likely you wouldn't have been able to obtain conventional financing for this property, and went well over $300,000 above asking price. So that shows us that folks are back and people are starting to see that this is the new norm with the market, right? You're not going to see rates in the 2s or the 3s again. Now, they'll go down eventually from where they are now, in my opinion, right? When after the Federal Reserve can tame the inflation situation, but nothing like in my opinion, what they're thinking. Right, we got very spoiled during the pandemic with those things, once in a lifetime style rates. And on the flip side, you had just given us this great breakdown of what's going on in the banking industry. When you see there's turmoil, especially in our regional banks here, Silicon Valley Bank being in Santa Clara, First Republic being in San Francisco. Now we're hearing about PacWest in LA. All 3 of these are in California, right? And in my opinion, they're starting to see the value of investing in hard assets. Now, when the stock market has been rebounding like it's been in 2023 and surging, I'm seeing so many more people coming to our open houses. So I'm thinking, all right, I'm getting 60 or 70 groups at my open houses each weekend. Why? My assumption is because when the stock market is rebounding the way it is, they know that they can secure that down payment a lot more readily. And then when they see what's happening in the regional banking industry, they can invest money in hard assets like real estate, which is there, they own the land, and any basic supply and demand curve will show you that over time you're always going to make money in real estate. They're putting those two together, and we're seeing those buyers coming back.
Yeah, no, I think you hit on some really important points and some valid points. And here's the thing is that I think everybody's settling in with the fact that the 2s and 3s are not coming back, which that was a given. Look, that was part of the stimulus program, or QE as we call it, quantitative easing. That's what happened, which subsequently, by the way, the Fed is the one who caused this inflation. Think about it. If you are out there bringing rates down to the 2s and 3s, what are you doing? You are having everybody jump in to buy houses, which does what in simple economics? More demand, higher prices. That's called inflation, right? And then when you hit with a pandemic, and then we have a supply chain problem, and here we go, everything got way more expensive. This is the reason why your eggs are $90, right?
Yeah.
It's just the way it is. So back to rates. I see rates coming down into the low 6s, I would say, by summer. However, here's the huge delta and question mark. What's going to happen with our budget? Are we going to be able to pay our debts as a nation coming June? Little Birdie says that Janet Yellen, Secretary of Treasury, over the weekend said that it looks like both parties are coming together, and so far they've agreed to some things. We're hoping, right, that this kind of disaster is averted, because if it's not, folks, rates will go back up into the sevens. It'll be a disaster. And then people are going to get back on the fence and not want to do anything. If not, and the Fed stops increasing rates, you're going to see a run on real estate because rates will come down. Look, already we saw that CPI came in at what, 4.9%.
Mm-hmm.
Remember, we peaked at 9.1%, folks, not too long ago. So here we are. And the reality is that inflation is coming down. And as inflation comes down, so do rates. That is exactly what's going on. So TBD, to be determined on our budget. That's the big thing. But if we can overcome that, those of you who are waiting, again, Uncle Ed is going to tell you, I wouldn't do that. Secure your property now, get a good deal. Get your tax write-offs for mortgage interest and property taxes, and then refinance later. Because by the time you refinance, let's just call it in 12 months, you have 12 months of extra equity that cost you nothing. You didn't work for that money. It's your house working for that money, right? It's free money. And so that's the smart way to look at this, is from both sides of the proverbial coin. Make sure that you are not the only one working hard. Real estate is always going to be a viable investment. Look at the past, even in 2008. For those of you who bought, not ran away, but bought in 2008, where are you standing today?
When everybody was running away, you ran towards the quote unquote fire.
The contrarians, like
Right.
Buffett, by the way, if you don't know, Buffett is one of the largest contrarians. And look at him, he became the largest investor on
When
planet
they
Earth.
zig, you zag, right?
That's it, man. You just got to go against the sheep, right?
Yeah. And you had mentioned the equity that was passively built just by being a homeowner through home ownership. You earlier in the call, you had mentioned credit card rates, interest rates being around 21%. Is that correct?
Yeah.
How much would you say in today's market right now, a home equity line of credit, roughly the percentage for that would be?
You're going to be in the nines.
So if it's in the nines and then credit card debt is 21%, it seems like going through a home equity line of credit to pay said, expenses is probably
Yeah. That's one way of doing
half
it. And
the
depending
interest.
on what your rate is on your existing first as well, right?
Mhm.
But yeah, a home equity line of credit is one way to do that. The nice thing about home equity lines of credit is you only pay on what balance you carry. And as you pay down the balance, you also have a lower payment
Mm.
because it's only on the balance, right? It's not like a
Yeah.
regular loan where if you get a loan, as you pay it down, you still have the same payment, right? Because it's fully amortized. So
Right.
those kind of things are really important. It gives you a little bit more, breathing room. And as you maybe get a bonus, throw it towards that, right?
Yeah.
These things are really important. That's where a good financial advisor comes in as well, to teach you how to make the most out of every penny and then get rid of debt and accelerate debt payoff, right?
Hmm.
But equity lines of credit are great,
Yeah.
great way to go.
And we talked about supply and demand. I was talking to a builder yesterday who's based in Menlo Park, and he had mentioned that we are about 1.5 million housing units short in the state of California. And that, we've had around 1.9 million folks that have left California since the pandemic, but 1.4 million that have come in. So the net loss is around
Five.
500,000 people
Yeah.
that we've
Yeah.
had in a state that's, just under 40 million. So we need houses. And, with so much of like the regulation that's going on, we're hoping that they can kind of like loosen up the belt a little bit with some of these regulations, because if we're keeping these rates high and builders don't have that confidence to build because of those high rates, well, who is that benefiting? Right? Builders aren't building. We need more houses here, right? We're in a chronic shortage situation. And it's just a really interesting time. And I think that goes back to why I'm seeing so many properties in our area go above asking. When you look at the standard headlines, everyone's talking about, oh, everyone's leaving California, especially San Francisco area, with some of the office vacancies. For some reason, they correlate that to residential. Commercial real estate and residential real estate are different things. right?
They are
And I've
vastly.
totally noticed, right, how much the prices even in San Francisco, as you had mentioned before the call, while we were waiting for the mics to warm up, one of those properties were going significantly above asking price.
Yeah, over 230,000 over asking.
Look at that. We've had in San Jose metro area, and then San Francisco is a close second. The biggest significance in the inventory decrease year over year. In San Jose, it's a little over 30%. That means we had over 30% more listings last year than we do this year. San Francisco is a close second. What that tells me is there's no panic selling going on in our area.
No,
When folks are sitting in boatloads of equity, they don't need to sell. It's not a need, it's a want. They want to sell to buy something bigger, or hey, I want to sell and I want to move out of the city and go to San Rafael or Ross, Greenbrier, whatever, right? And buy something, let's just say on the coast over there for cheaper. That's a lot more likely than folks just like, oh my God, I have to sell my house now. I don't know what to do.
yeah.
I'm gonna live in my car and figure it out.
Panic
You know?
sellers.
Yeah.
Yeah, and to your point, look, they don't need to sell, but here's what's going to happen, folks, is that what's going to move the needle, and until then, it's not going to move the needle. Sellers are going to move, guess what? When rates come back down to the fives,
Mhm.
because then they psychologically know that that's a really good rate. Twos and threes, they know is not coming back, but fives will move the needle, and I think it's going to happen within the next, I don't know, 9, 12 months.
Yeah.
And so we'll see some inventory starting to come on the market because sellers will move, right? Because sellers become buyers and they move up and they move out, that sort of thing.
Yeah.
We'll see that, but we're not going to see that right now. And so in the meantime, unfortunately, sometimes you can't have everything, right? So sometimes
Mhm.
you can't always hit home runs. So what I tell you, the analogy of baseball here is get on base. Let's get you in and scoring. You don't have to hit the home run. Not everybody is a home run hitter, and that's okay. Get on base, get that RBI coming in, and then you'll be able to benefit from it. But to not want to get into the game because you don't think with 100% certainty you can't hit a home run makes no sense.
Yeah.
Get suited up, get in the game, get on base.
That's a great way of looking at it. I mean, I've never heard of anyone who, let's say after talking to him for 5 years, like, man, I should have never bought a home. And obviously that's what we do. I get it. Like, yeah, well, of course we have a bias. I mean, that goes without saying.
But we have a bias, but here's the thing, though. Let me say something: is that we have a bias because we believe in it. That's the
Yeah,
reason why we got into this. It's
exactly.
not a bias because somebody wrote $1 million check to come and spread a bunch of lies just to get into the business and to be a seller. To come in and sell you something and be a fast talking salesperson. That's not what happened. We
Yeah,
got into these
right.
businesses because we believe in homeownership, sustainably, by the way, and we believe in relationships, and we have the opportunity to make a difference in people's lives. As cheesy as that sounds, it's the truth.
Right. No, it absolutely is. You're totally right. And we have a bias, like I was mentioning, but I was gonna say exactly what you said. I mean, we believe in being able to help people, passively build equity, right? I mean, we see how it changes people, especially in the middle class, which unfortunately in California has been dwindling so much. We
Yeah.
see the value of being a homeowner, and even if times get tough for certain folks, you have a unexpected medical bill or a death in the family, you need to pull money out for whatever. You can do that through your home. We don't advocate using your home as an ATM, but I mean the options are there if you need to. You're not going to be on the street, and being a renter will never get you that. I mean, I'm sitting in a home office right now that I write off every single year off of my taxes, right? A certain amount of square footage in my home. So I mean,
Speaking of that, I heard a statistic that says that we, the people, work 4 months out of the year just to pay taxes. So we are, in fact, part-time employees of the IRS.
unpack that a little bit more. 4 months
Well,
to
four
pay the
months.
tax.
That means we work from, let's just call it from January through April. Those funds is what we need for our taxes because that's what
Mm,
gets taken out of our checks.
yeah.
So we are de facto IRS employees,
How
right?
about that, man? I never
Just
thought
like
I
I
would
said,
consider
if you have a
myself
lot of
that.
credit card debt, you are a part-time employee of the credit card companies
Oh
because
yeah,
you're
you bring in the
working
revenue.
to pay them, right?
Right, right.
In real terms, we're talking about. So,
Yeah.
these are kind of things. What other investment can you sleep in it, get passive income, in assets called equity, get
Mhm.
really great tax write-offs, and on top of that, be able to exempt some of those capital gains with the capital exemption rule, which is the capital gains exemption rule, which is, look, if you're single, you can, and you live in the property for 2 years, you can exempt up to $250,000 of the gains when you sell it without paying taxes on it. And if
Mhm.
you're married, 500 grand. Where else can you do all those things with one investment?
Yeah,
You don't.
right, right.
You don't. It's real
That's
estate.
very true. And in today's market right now, what would you say your bread and butter with loan options are? Because to me, I've always considered you as like a Swiss Army knife. And I say that because I know
Yeah,
through a
thank
lot
you.
of banks, they have some great, programs. They're very limited, like you said, very narrow. Like you got to fit in this
Yeah.
box, especially if you're self-employed. I'll tell you from firsthand experience, good luck. With going through a bank, but that's just my opinion. Now with a guy like you who has all these options on the secondary market and what you can do, what's like your bread and butter right now? What's the most interesting?
The most interesting, and again, I do both vanilla and chocolate kind of loans. Let's just call them those. The vanilla ones are that little box. However, here's what I'm going to say. If you are a high net worth person, then full disclosure, you're probably better off going to a bank that's going to give you the house in exchange for your deposits because I don't have depository kind of lenders. That's not what we do. We're strictly mortgage lenders. So the other side, which is the chocolate side, is really where I live, right? Things like if you're self-employed. Give you an example. Most self-employed people, they write off everything, right? But the problem is that when they go to apply for a loan, they don't show a lot of income because they're writing everything off, and so there is there's a problem there that's disjointed, right?
Yeah.
So
And
I
are they,
have pro.
I'm
Mhm.
sorry, Ed, I was going to ask you when you say that when they're writing everything off, does that basically show an individual like yourself, all of those write-offs as a loss?
Yes, so it shows up on your taxes as a loss, really, for most people's.
Yeah.
For
Okay.
most people. Now, that doesn't mean that you don't make money. Obviously, you're doing a lot of write-offs, and some of those write-offs are what are called non-cash write-offs. What are they? Depreciation.
Mhm.
Maybe you have some equipment, right? Those kind of things.
Right. Right.
Amortization on loans, those kind of things.
Mhm. Okay.
But then I have a program which looks at your cash flow, not your tax returns, but cash flow, the true story of money coming in and out. I'm going to give you an example. I have a lady right now who owns a daycare business. When I did the traditional self-employment income analysis, her monthly income came out to $5,412. Well, that's not much for the Bay Area, right?
Right.
Well, I did a cash flow analysis type of loan, and guess what her monthly income came out to?
I,
32,000.
wow.
I mean, exactly, right? So
Whoa.
you're talking a $15,000 swing. That makes all the difference. She went from not being able to buy a tent to being able to buy a $2 million home. That doesn't mean that she needs to buy a $2 million home, but you get my point.
Yeah.
Now she's in the game.
She's well qualified now.
Right,
Yes.
exactly. Another one too is maybe you're an investor and again, you don't show a lot on your tax returns or you show a loss. We can buy that property using the rents. Matter of fact, not even the actual rents. We don't, that property doesn't even need to have tenants or leases. We just look at an analysis of rents for the area and we use that to qualify and approve you. These are called DSCR loans, which are debt service coverage ratio loans. Don't memorize it. Reach out to me. I can explain it to you in more or greater detail. But we have programs for all that, right? Let's say you're a person who your immigration status isn't 100% up to par right now. You're working on it, right? Maybe you're working on a visa. Maybe you're working on asylum. I have a program as long as you have a tax ID number, we can get you into a home. Let's say you're watching this from another country and you have zero financial footprint in the US. You live in Italy, or you live in Greece, you live in England, but you want to buy a property here in the United States. I have a program for you, which is for foreigners who have no footprint here in the United States. Again, there's tons of programs. Maybe you don't have money down. You need some down payment assistance, or you have low down, or you have bad credit. You've had a bankruptcy recently. Those kind of things. Reach out to me. Maybe you're self-employed and you don't want to show any kind of employment because you really just don't have that to reference right now.
Yeah.
just call me. Here's my message to you. Don't assume. Call me and let's talk it out. Let's put a strategy, because even if I can't help you right now, I'm going to prepare you for success. We don't abandon people. This isn't a deli where we're calling out numbers like 48. No, that's not how we do it, right? This isn't
Yeah.
giving you sandwiches. This is your future. We don't just call out numbers and go next. No, we're here to nurture you into success. And I say that with great passion and importance, because I know there's a lot of organizations out there that if they can't make money right now off you, they just decide to say next. That's not who we are. We nurture people. We're advisors, we're educators, which is why we're doing this video.
Yeah, exactly, man. On that note, I think you left it at a perfect point, and I really appreciate you tuning in, folks. And Ed, I really appreciate you jumping on with me here. I'm happy
Man,
that
I
we're able
appreciate
to do
you.
this. I thank
Yeah, man. I
you.
mean, this is what our passion is, everybody. We love doing these. We want to
Yeah,
disseminate this information. There's a lot of teleprompter information people out there, and that's called the media.
yeah.
Look, we have boots on the ground 24/7. We literally live and breathe this every day, 22 years over here. This is all I do. I wake up thinking about it. I go to bed thinking about it. No joke.
And I
Reach out to
follow
us.
these things, yeah, on a high level, at least in your area with the lending side. I just follow it 7 days a week on a high level overview. But every single time that you and I chat, whether it's through something like this or on the phone, or even when we have coffee, I feel like I learned something from you. From
Hey,
that,
man, and right back at
you
you,
know?
because you do the real estate side. And
Yeah,
this is the reason why AI can't get rid of us. It's
yeah,
because
exactly.
there's so many little nuances. Real estate is packed with little nuances, folks. And that's not just on the real estate property side, but it's also on the financing side. There might be one little thing we need to tweak. Boom.
Right.
All of a
Yeah.
sudden you're in a home.
You see a lot of these headlines, right, that are misleading, and that's a big reason why I wanted to jump back on here and start doing these things again, because this is what I reference to our clients, right, when
Yeah.
they want the scoop, the real scoop, the unbiased scoop of what's going on. I just send them stuff like this, instead. So I appreciate you, man, and yeah, until the next one. Hopefully, in about 2 weeks from now, we can drop another episode.
Let's do it. I'm ready.
All right,
Have a
Ed.
great day, everybody.
Hey, and you have a productive day, ladies and gents, and you too, Mr. Edgar Diaz.
Thank you, sir.
All right, take it easy, guys.